Good evening, everyone. I'm Aditya Kumar, your moderator for this VCM. Before starting today's session, I would like to apprise you all about the 21st World Congress of Accountants, which is going to be held for the first time in India from 18th November 22 to 21st November 22. To know more about this, I would like to request the technical team to play a short informational video. Kindly see this and register yourselves for this Congress to make it a success.
Geographically, the 7th largest country in the world, one of the oldest civilization, world's 6th largest economy, a global hub for innovation with one of the largest startup ecosystem. India, city of Mumbai on the western coast of Arabian Sea, among the most advanced and modern metropolises in the world, and the financial capital of India, gears up to host the most prestigious accountancy event of the world, 21st World Congress of Accountants from 18th to 21st November 2022, an event held every 4 years. The Olympic of Accountancy Profession. India hosts the event for the first time in 118 years since the WCOA came into being in 1904. Around 10,000 delegates expected to join virtually. More than 6,000 delegates from over 135 countries would congregate to exchange views at the world's most advanced Geo World Convention Center. The theme, Building Trust, Enabling Sustainability, will inspire the future of accountancy profession to create sustainable economies for the future.
The ICI is honored to be the host for this mega event, which will bring together the world's largest conglomeration of professional accountants, regulators, leaders, and visionaries to advance the cause of the global accountancy profession. Now, with the ease of travel restrictions across the world and the situation returning to normal, we are working towards creating a never before and a unique experience for all our delegates. The year 2022 marks the 75th year of India's independence, and the Government of India is celebrating the year in a big way to showcase the glorious history of India. World Congress of Accountants 2022 would also be celebrated as a mega event to showcase the important role that the accountancy profession has been playing in the economic and social development of the country.
A never before witnessed unique experience of learning future trends, emerging avenues, enhancing skill sets, networking, and to explore the incredible India awaits you.
We at ICAI are pleased to host you here in Mumbai, the financial capital of India, for the 21st World Congress of Accountants with the theme Building Trust, Enabling Sustainability from November 18 to 21, 2022, and give you a professionally enriching and personally rejuvenating experience. We are hopeful that the conference shall be stimulating and productive, and your stay in India will be a memorable experience. Once again, we invite you for this enthralling convergence in India, the land of multicultural, historical, and spiritual inheritance since centuries.
Insights from the stalwarts of the profession, international and national standard setters, regulators, and trendsetters will constitute the panel of speakers at WCOA 2022. Let your dream get bigger. Come, be a part of this mega celebration. For registration and sponsorship opportunities, contact. Organized by Institute of Chartered Accountants of India under the aegis of IFAC.
Thank you, team, for playing that video. Friends, we are delighted to welcome you all in this VCM being organized by the CECLEA Committee of ICAI. It is my pleasure to be your moderator for this session on the topic Global Opportunity in Enterprise Risk Management. In a short while, we will start this VCM. And before we start this, I would like to apprise you about this committee. The committee, in line with one of the Institute's objectives of partners in nation building and with a vision to contribute to economic development of India, aims to undertake such activities to technically equip and broaden the scope of expertise of the members to enable them to derive advantages in this rapidly changing scenario and this paradigm shift that we're all facing, to enable the members to render various business advisory and support services. The program for this evening will be undertaken by Mr. Aditya Kumar, my namesake, and we have around 1.5 hours or 45 minutes of discussion where he'll run through his presentation on global opportunity in enterprise risk management. Before I hand it over to Aditya to begin his deliberations, I would like to make his introduction. He is a fellow chartered accountant from the ICAI and has also completed his BCom from Bangalore University, carries a diploma in information system audit from the ICAI. He has also completed his certificate in forensic accounting and fraud detection, an area which is of paramount importance in today's day and age, certificate in business responsibility and sustainability reporting, certificate in international financial reporting and international standards of auditing and robotics in finance from the ACCA UK. He has actively participated as a speaker in professional forums like Society of Auditors, CA study circles, branches of SIRC of ICAI, regional training centers of CAG of India, Fiscal Policy Institute of Government of Karnataka, Madras universities, and various other educational institutions. He has co-authored a book on AI in financial services and contributed to leveraging data analytics in internal audit. Friends, with that CV in mind, I think we're in for a great ride ahead and a great learning on the subject. And since I just want to make one housekeeping announcement before I let Sir take on, is that since we're on different platforms, we will have a Q&A at the end of the session. We've kept 15 minutes, so please put in your questions into the chat box so that I can take them up towards the end of the session. With that, Mr. Aditya Kumar, the floor is yours.
Thank you so much for the introduction, sir. I hope my screen is visible and I'm audible.
Absolutely.
So when we talk about risk management and about risk per se, we do so many things during our everyday life, and we don't consider that as part of a risk management. As simple as, to start with, we are all having this VCM through video communication, internet, etc. I always have this my geo dangle with me and would always ensure that my team has one internet always as a plan B. So like this, there are small things that we do in our everyday life wherein we don't realize that we are actually managing something called as risk. So with that introduction, I again thank you for this opportunity to discuss on a topic which is quite relevant and important from the perspective of both people working in the industry as well as people working in the practice. Now, when we talk about the risk, we would be, the whole presentation, we would be typically discussing some amount of introduction to what is risk, what is managing risk, emerging risks typically, and what are the risk management techniques, and finally on where are we going to have our next professional opportunity coming from the risk management aspects. And risk management by now has itself gained to be a separate profession by itself, or a separate specialization itself, the way the market has opened up. Now, when we talk about risk, in English, we typically also use the word threat. We also use the word vulnerability interchangeably. But then if you look at that in a very closed manner, that there are differences between the three. Very simple example is don't share your PIN number or password with anybody. We say it's risky. What do we mean by risky? It is not sharing the password or sharing the PIN that is risky, but the misuse of that and the loss of the information, loss of money, loss of reputation, that is at risk. So password typically is vulnerable. That's the reason they say you need to have a strong password with numbers, hash, capital letter, small letter, a combination of that which cannot be cracked. Otherwise, if you keep the password of your date of birth or initial, it becomes easier for somebody to crack the password. So password by itself is vulnerable. Now, once it is vulnerable, it can always be misused, and that is what we call it as a potential cause that may result in harm to a system. Now, once that is misused, the resources or the information which can be unauthorizedly used or can be damaged is the risk that we are talking about. So to understand better, risk is something, it's a potential loss or destruction of an asset or loss of information. And at times they may be quantified, at times they cannot be quantified. Loss of reputation, for example, cannot be quantified. So we are all talking about something that could be a loss and what can be done to mitigate it or what can be done to protect against this. Now, coming from the field of profession where we always are in the audit, typically I come from the audit background. If you look at the industry per se, you will see that there are many corporate fallouts because of purely because of poor risk management, I would say, and organizations have faltered due to risks not being managed or detected. So in an organization, you have operations, you could have processes, you could have strategies, you could have accounting, you could be finance. Each function has its own risk and that needs to be mitigated. Now, if you look at the corporate governance aspect, the compliance requirements, you will feel that there is somewhere a point where the risks were either not seen or were not detected or were not managed well, considering the volatile business environment or the regulatory landscape, etc. Now, when this happens, there could be financial loss, non-financial loss, loss of credibility, etc. Now, what we are looking here is, as a person, we do manage certain risks in our own life, in our individual capacity. But what about an enterprise? What about an organization wherein somebody has given us the power to manage it or delegated their power to manage it, or we as professionals are responsible to review the results of that company or the operations. Now, why it gains more importance is I managing my role risk is different. But if I have to manage somebody else's risk, that becomes a lot more important. And you need a professional to do that. Now, that is the topic that we are going to discuss today as to how we as professionals would be able to manage the risks of enterprise, of an organization, of a company, which is a separate legal entity. Risk is what can go wrong in simple words because the future is uncertain. What could be the deviations? We don't know. So we are trying to see whether we are able to visualize what can go wrong and then take necessary steps to ensure that things are on the right path. When we talk about management, purely the management is the ability to control the affairs of a business or ability to control by using the available resources. So therefore, the definition of enterprise risk management comes from the fact that you are managing the risks of an organization either as a businessman or either as a professional. Now, how do we go about it? In any business, for that matter, there is something called as a vision. Now, what is the objective of that organization to be in existence? No, it all starts from understanding the organization's vision, and not many would attach importance to the vision and mission statement. But I feel that's very, very important because once you know what the goals are, you will then have an actionable plan as to how to achieve those goals. Now, those goals could either be financial goals or non-financial goals. You could have a market share, you want to have a bigger market share, you want to give value to your customers. So it could be any goal that you have. Once you have that goal, you would obviously have a chart of action. This is how I'm going to achieve it. Now, in that process, you will always have certain challenges to meet. All the things that you have planned may not come in the manner it has to be, or may not be the way as it has to be. So what I consider here is some of these challenges are nothing but risk. So the risk management starts from the fact that an organization has a vision, it has a goal. To achieve that goal, it has certain plan of action. And when they execute this plan of action, it is quite possible that they may have impediments in the in between, they may have hurdles in between, and it is wiser to overcome those challenges. So the conclusion is risk management is for everybody, is for every organization. And can the risks be anticipated? Risk can be anticipated based on the experience that somebody would be having, the company would be having, their industry could be having. There could be experts who will advise the company. Like, people will always say, learn from a wise man, don't commit the same mistake. So when we look upon the history, when we look upon the case studies, when we look upon somebody else, okay, they have also undergone the same thing. They underwent these kind of challenges. So what is that we should do to ensure that we overcome these challenges, or how prepared are we to ensure that we meet these challenges to meet the objectives of the organization? So that is where the first need of risk management would come in. Now, when we look at the risk management, first thing that would come is identifying the risk. Now, it could be, as I said, anticipating it by experience, by seeing around in the industry, by using technology, data analysis. You will know, okay, these are the kind of risks that you might encounter. Now, once you know that these are the kind of risks that will be there, the next question is analyzing the risk as to what could be its impact on the operations or on the strategies or on the financial aspects of it. So that's a very important aspect, because unless it really has a material impact or a significant impact, you may not want to analyze it or spend more time towards it. So typically, once you identify the risk, you also try to filter down as to whether it is going to really impact the business or the operations of a company or of the entity. And this impact could either be financial impact, where there's a loss of money, or non-financial impact, like possibly reputation risk, loss of customers, right, etc. Now, once we know that this is going to be the possible impact and this is going to be the possible loss, the third aspect would be how to mitigate it. Now, how to mitigate it? There is strategies of how to deal with the risk. Just to give you a sample, there are 3 or 4 types. If you have to transfer the risk to somebody else, that's where we call it as insurance. People take insurance so that the risk is transferred to another entity, and there is a monetary compensation if at all there is a loss. Or you redesign your procedures in such a manner that the risk is completely avoided. Or we have to bring in certain controls and ensure that they are mitigating the risk. You can use technology and bring IT level controls, or you could have the traditional manual level controls, wherein though there is an activity which could be risky, but it is kept on check by certain control points. Now, if a risk can neither be transferred, can neither be mitigated, can either be controlled, then what is residuary is something which we need to see as to whether we really need to take up this particular task and bear the risk, or should we live with it and bear whatever could be the possible loss. So the first 3 steps is to identify what could be the risk. The second step would be whether that is going to have financial or non-financial implications. And the third aspect is how to mitigate that risk. Now, once we have these strategies, then we are supposed to keep an eye over it. The story doesn't end here because these tasks are routine in nature, they keep coming up. Therefore, you need to monitor and see whether these transactions are repeated in nature, and wherever the risks are repeated, you need to have controls to ensure that it doesn't recur to the extent possible. As I said, in an enterprise, in an entity, in a business, everything is dynamic. You have changes in the law, changes in the business model, changes in the technology. So the risks also keeps evolving over a period of time, and you have newer risks coming up. And every time you identify a new risk, you have to go through this cycle of identifying the risk, analyzing its impact, trying to have a mitigation strategy, monitoring it over a period of time, and then improvising it as to what can be done better for the risk management aspect. So broadly, what we are looking at in the risk management sphere is how do I identify a risk, quantify the risk, mitigate the risk, monitor that it doesn't recur or we are not into loss, and then improvise it. Improvisation is a continuous process. Now, once we are done, we are now looking at how different is our enterprise risk management from the traditional risk management, which we have known for quite some time. Now, typically in the traditional risk management, there was not much focus on the emerging risk like social media risk, strategic goals, etc., which are all which we are going to discuss separately. Now, based on the general perception that people had on the traditional risk management is mostly insurable. So whenever you talk about risk, we talk about insurance, but it is more than that. Second thing, I feel is the approach towards traditionally the risk management was detective or reactive in nature rather than being proactive and continuously improvising your procedures to ensure that even the emergent risks are taken care of. So even if you look at the regular risk that we have encountered and the controls that we see, we always call it as preventive controls or detective controls. And we always prefer that a preventive control rather than things going wrong and then getting detected. So again, it's very, very important to know the difference that we need to move away from the traditional way of looking risk and risk management towards enterprise risk management, because if you look at the strategies that are being used in ERM, we are not looking the process as a risk. We are looking how this process will have certain risks that is going to have a collateral damage to others. Therefore, we are moving away from the silo based or specific to the unit towards an organization as such, and we are looking into the interdependencies of various units, various processes, and then trying to see what best can be done to mitigate the risk. We have also experienced that certain entities were risk averse, that means they traditionally did not want to take the risk, but then as the business has evolved, we know that the risk and reward go hand in hand. But I'm not saying that take big risk without even considering its impact. We are only saying to be cautious, to take calculated risks, to ensure that we have enough safety net before we jump. It is essential for the business to grow, and along with its growth comes other challenges, and other challenges will have to be met with accordingly as and when passes through. So enterprise risk management ensures that you do take the risk, but with a safety net with you. And when we are talking about all this, we are also looking at what standards or what is that we are benchmarking towards. Typically, in the old risk management, it was the ISO standards and so far, but now we are looking at global standards like COSO in our enterprise risk management strategy. So in this presentation, we would also take you through what does ERM contain, what does an ERM taxonomy, how do we build an ERM, and what, as a professional, where is the contribution coming from? Now, when we talk about ERM, you could ask me, fine, why do you think this is better than traditionally, and what is that we were doing right now which is not there? ERM typically looks at the impact of the risk at an enterprise level and not at a particular business unit level. So the risk was, there is a chance that something could have left between the silos or between the units. That itself is a risk. But here we are looking at an integrated structure entity as a whole. We are also looking at the interrelationship between one business unit to another and see how does it affect the entity and to see the bigger picture. You may find that, okay, there's a particular risk in the business unit, say in accounting. We also need to see how does this risk perceived in one unit is going to impact, say, production or operations or strategy, financial reporting, etc. So we are looking risks from a holistic point of view, and we are looking at the bigger picture. We are also looking into certain risks which hitherto were not considered. For example, the climate change risk, the risk of social media, the cultural differences, the IT and cyber risk. So this is going to take a lot of time for an entity to analyze how are these risks going to impact the company, impact the enterprise and their goals. So ERM definitely is a better way to look at things where you are not only going to look internally, but you are also looking at externally. And this also includes any strategic decisions and any risk mitigating capabilities that we need to look into. The other aspect of enterprise risk management is also that we are dealing with something, what I call it as currently unknown, but knowable risks are also there. What we know is anyway covered, and traditional risk management was there. What we are trying to do is trying to find out what we do not know. And an effective ERM should be a valued strategic tool. Whenever we are taking decisions, it is better to embed those decisions, and the entire ERM idea is to be part of the organization, be part of every process, and be it in their DNA. So that's what we are trying to look at it. Now, what does ERM include? When we talk about ERM inclusion, we are talking about risk consciousness. Risk consciousness is knowing and understanding and appreciating that there is an element and we are not running away from it. We acknowledge that there is a challenge, we acknowledge that there is a hindrance, but we are trying to find out how do we get away from that in a manner that the operations continue and our goals are met. Risk consciousness also means that we are fully aware that there is going to be a hindrance like this, but we also have a strategy as to how to overcome that consciously. It's not that we are just walking blindly there, but we have certain strategies, and based on that strategy only we are working out. The second aspect is on the organizational resilience. What is organizational resilience? It is how can a company should ensure that how it can learn from its past, how can it be relevant in the future. Resilience means what? Despite having certain challenges, despite undergoing difficulties, it is the number of times that they are able to overcome that and be relevant to the organization, relevant to the society and to the community and to the business. So what enterprise risk management also looks at is how is your organization's culture is, how is it being dealt? Does it just fall down with one challenge? No, it has to find a way out to stand on its own feet to see how these challenges can be mitigated and how it can continue in the future. The third aspect is on the risk appetite. The risk appetite means how much can you bear, how much risk can you bear, and more important is keeping the vision and protecting the interest of the stakeholders. It's very, very important. being in an enterprise where we are responsible for somebody else's money, for somebody else's resources, for somebody's trust that we have, it is very important for us to understand that we will ensure that the risks are taken in a calculated manner. That is called as risk appetite. How much risk can we bear? Are we pushing the bar too much? That is something which needs to be considered. Appetite means how much we can bear. The fourth aspect is on the identification part. Looking at the business dynamics, looking at both internally, externally, how good are we in identifying the risk is something which is part of VR. For example, COVID-19 came, there was a pandemic, there was a business disruption. I'm sure nobody would have actually thought about that there could be a situation where there's a complete lockdown and the movement of people would have stopped. Now that this has happened, many enterprises are anticipating that if there is a pandemic, how should we ensure our business continues? So that leads us to the next point on how do we have our business continuity planning in such a manner that even if there is a pandemic, we should be able to run the business with as much little disruption as possible. Organizations, firms, businesses did lose money, did lose business because one is the loss of life, one is loss of business, and loss of resources. Once we have a good business continuity plan, learned by the lessons in the past, we are always prepared for any emergency and response system. So business continuity plan and disaster recovery plan typically go hand in hand. In the heart of all this is what I call it as the controls that are in place, the risk mitigation and controls that are in place. So many enterprises, and when all of us were in lockdown, the business had to go on, audit has to go on. We all move towards a remote audit, or we move towards work from home, which was there as a concept, but not practiced largely. But now it has become some sort of a norm to have work from home. So when you had those things, what about the controls? How do you ensure that staff who are working at their places have access to information, does not share information to somebody else? So there were a lot of thought process that went into it. So in enterprise risk management tries to see how we can mitigate the risk in these kind of emergency situation and these kind of situations which they would have dealt as well in the past, based on which we move to the topic on risk assessment and analysis, where based on all this input data, we try to see what are the risks and how it needs to be mitigated. Typically, risk is classified as high risk, low, or medium risk, and sometimes they would have even been given points or grade based on which the severity is highlighted. So if something is really high risk, it is expected that the management take action immediately. But if it is a low risk with little impact, then there is some time available, there is some oxygen available for you to breathe and then take certain actions. Now, once we do the risk assessment analysis, then comes how do we monitor it and keep reporting it. Now, once you monitor it, you have to ensure that whatever objectives you had to meet is those objectives being met, and having met, you need to report it to the top management for their blessing and for their concurrence as well. And if there are any deficiencies, then has to be an action taken on that. Now, any enterprise for that matter is run by humans, run by us. So in that case, what happens? There will be a new batch of people coming, there are new risks coming. It is always advisable to have a process improvement and training. Based on all that experience we have to ensure that the staff are adequately trained, and there is always a process improvement. We can never say that we have achieved a perfection. There is always scope for improvement. Improvising will always be there. So we need to see whether there is a scope to improvise our process, and then also continuously train our staff over the risk management aspects. So our enterprise risk management typically covers all these aspects which we are going to discuss. So is there any doubt or any clarification that is required? I don't see anything in the chat box now. So I'll continue with the presentation. Now, when we have the enterprise risk management and we know what it constitutes, typically you might ask, what is the benefit out of this? What is that we are going to get out of this? So there are 6 or 7 aspects that you need to consider. One is reduce enterprises risk exposure through improved risk visibility. So you are now going to take a calculated risk. You are going to visualize that there are certain risks which I had not seen. Now I have seen, but I'm not going to go back. I'm still going to take forward by wearing protection, by having an armor. So thereby what I'm doing is I am protecting the entity and then going ahead, because these days you cannot say that there is a risk, I'm not going there. You need to have a proper protection when you're going ahead and to have a risk management strategy, and ERM will help you to see the risks that is forthcoming. The second is identifying emerging risks and opportunities. Now, this is not philosophical. Wherever there is a risk, there is an opportunity. You might consider that, this is an organization where I'm working, there's nothing happening. What could happen if it closes down? That's a thought process anybody can have. But look at the other side is you have a great opportunity to turn it around. I personally had an opportunity to work in another organization wherein it was like thinking, should I really continue here? But when I actually met my mentor, then said, why don't you look this as an opportunity to turn it around? The way you look at things will completely change. It's not that we are just saying the glass is half full or glass is half, but think whether the glass itself is of a good size, or you can say the water is not adequate. So there are different ways to look at things. And I personally feel that wherever there are places where you find this is the end, nothing else can be done, I feel that there is a great opportunity there. It is again depends on how you empower your decision makers to take that confident action and see that the organization takes forward. Needless to say, there are many organizations whom we thought we had written it off, we thought that it is not going to happen. But after a few years, we see there's a good turnaround. Now, how were they able to do it? Because in adversities, they found opportunities. That's the only difference. It's the same in practice, it's the same in the industry, it's the same in our personal life. I feel that whenever there's an adverse situation, there is an opportunity. There's an opportunity to overcome that and try to look at things in a different way. That is what ERM is all about. ERM gives you that framework as to how you should go beyond. It doesn't give you a solution. It says that possibly you could apply this and then see whether you can go forward. The third,
Aditya, sorry, interrupting you. I think conversely, if we were to look at it from a point of view of organizations that didn't implement ERM or didn't have that resilience or the wherewithal to sustain themselves and went down, they were not able to turn around. It was because they did not have that risk assessment in place. It was because they were not thinking of all these aspects that we're discussing, which is why, classic cases like, Nokia, BlackBerry, I mean, top of the line, doing very well, all of a sudden just collapsed. I think a key factor would be that they did not have a proper ERM in place to enable them to think through not, collapsing.
Good example, sir. What I would also look at is possibly they did not visualize what a customer needs in the future. Precisely. That itself is a risk. And look at some of our public sector companies, unfortunately, which were at which were at peak. Yep. Why are they sick? Why are they not being able to perform? Because they were not able to forecast what the demands are. And the customer needs and changes are very dynamic.
Yep.
Now, we were happy with 4G. Now when the government announces 5G, people want 6G. They want something else. So the need of the customer is ever growing. And if an organization still sticks to, no, I will still give you 4G, we are not happy with it. Right? So I agree with you. Even with the products, when there was one camera in the phone, people said, I need two. When they said two, they said, I need three now.
Right, absolutely.
The third aspect is we have a concept called as risk register. Now, what is a risk register? Typically, you need to have at one point a registry where you note down all the risk. In a very simple language, you need a one-point reference as to what are the risks that your entity is facing based on the strategy, operational, financial, etc. Now, ERM will help you to integrate all of them and will help you to give you a faster and improvised decision making, wherein a unified risk register will help to update the requirements on a concurrent basis. And when you take a decision, you don't take a decision on a particular aspect or a particular process, but you look at its collateral damage and you take a holistic view of it and then take a decision. The fourth aspect is improvising the organizational performance. So if you look at it, once you manage the risk, your time and effort will also get reduced because you know certain things are taken care of automatically. And you also will know that once there is a particular action, there is something to protect it. So the corporate risk profile, its impact, everything is taken care of in ERM as a process and as a concept. Now, when we are all talking about risk and management, it is not left out only to the internal auditors or to the risk management team. In ERM, the concept is everybody in an organization should know what is risk management. Every process they should do, they should consider risk in that. That's the reason they say it will improvise our internal culture and business integrity. So it becomes part of the DNA of an organization that whatever I do, I always keep this in the mind and then do certain things. I will not do certain things based on my assumption or based on whatever has been told, but I go check what it could be the risk and then apply that control and only do it. So it comes as a process. So it is like having a maker-checker concept. It is within the process. The last two are very important is even now the government and the regulators are looking at risk management very, very seriously. Whether it is a bank or an insurance company or securities or even listed companies, even for unlisted companies for that matter, the government is looking risk management in a very, very serious matter. If you look at the annual reports of the companies, you will have a separate report on risk management. The statutory auditors are required to report on internal financial controls over financial reporting, which again is part of analyzing the risk. Our auditing standards has risk assessment and how do we go about mitigating those risks. Even for the internal auditors, they have the standards of internal auditing, especially on enterprise risk management. So whether you are on this side of the table as auditor or that side of the table as an industry, ERM is definitely required, definitely has to be part of it. Talking from the auditor's point of view, even in our own audit process, we have to naturally build in certain strategies to ensure that the audit risks are taken care of. On the other side of the table, you ensure that all the processes risks are considered and mitigated accordingly. And that's the reason why we are saying that it is so important that even the regulators are looking at it very seriously. And finally, when it goes to the board or when it goes to the stakeholders, when they look at the reports, they always look at these days on what is that the company is planning to do. How are they able to answer to the dynamics of the business, dynamics of the competition? How is my company better than somebody else in the industry? So all this then goes back as the essence of how good is your risk management. I have a couple of questions here in the chat box. Let me take it. What kind of work is available in the market in ERM space for chartered accountants? There's a separate slide I'm taking on this.
Right.
Any global opportunities for Indian senior chartered accountants? Definitely there are opportunities. In fact, I would say, Aditya, if you don't mistake me, that in our profession, my senior partner used to say that only when your hairs become gray, people start looking at you as an experienced person. So when you are senior, the experience counts. The vast experience that you have taken over a period of time by itself is a very good advice that you can give to people, saying that, hey, I have gone through this, I have experienced this, I know this is what is going to happen.
Right.
And the advice that a senior professional will give is far more valuable than anybody else. Again, it's my personal view.
Yeah, I think just to add there, that it was definitely considered so that if you have gray hair, you have more experience. But I think in the new gen, the millennials, the way they're thinking, the way technology is, by no means am I saying that the experience is not valuable. It's absolutely valuable. But I think the perfect mix is where both generations are working together. You have tech also playing its role, and you have that experience reading that tech or that analysis and giving their opinion. I think that will be like a power combo that for a client or as an advisor, that'll be valuable.
Just to give another small example, coming from part of the city where ready-made foods are available in plenty, the traditional foods, the taste is like the experience. It's still there, but the way it is packaged, the way it is presented, and the way the solution is customized is quite different. So as you rightly said, you need to have a good mix of both.
Right.
So when we look at the mix, when we look at the risk mitigation strategies as to how to go about it. So first thing that you would be considering is, okay, I have a risk universe. I know these are the risks. From this risk universe, I see that I do an assessment and see which is that is going to hit me first, which is going to have a very significant impact. So what I try to do from the list of risks that I have is I try to prioritize it based on financial implications or non-financial implications. Based on that, I try to see the result. Now, once I profile it, once I put it in an order, then I would put it to a flow chart. What is a flow chart? If it is very critical to the process and I am not able to find any risk mitigation strategy, possibly I would rather avoid it. I will take a risk avoidance stand and be away from it. But if the consequences or if the results are acceptable to me, I will do some risk mitigation strategy, either by improvising the process or transferring to an insurance, or rather reimagining and restructuring the process, and then continue to monitor whether the risk is mitigated. And again, it goes back to the second box where I need to do a assessment to see whether the priorities are taken care of. Typically, this is, I would say, it's a never-ending process, I would say, because the risks keep changing. You keep looking at it, you find different ways to mitigate it, and then you find a day that today I have ensured that these risks are mitigated, tomorrow morning something else comes up. So this particular cycle of risk mitigation seems to be an ongoing thing. Now, when we are talking about risk, one very important area that we also need to cover is the emerging risks that people are talking about now. There are one or two boxes more I would have added, but the space constraint here. The first one I'm looking at the top emerging risks. Now, who has determined the top emerging risks? I have not said so, neither somebody. If you look at the various literatures that are available in the websites or books that are available, every year the consulting firms and there are a lot of other agencies which do a survey and then see what are the risks that we are going to look at it. What are the new risks that we are going to identify? Some of the top energy risks that we are looking at today is the climate change. And just before the meeting, this meeting, I was talking about with Aditya on the essence of such sustainability reporting. Climate change is part of that. Look at companies which are, for example, on the seashore, where your sea levels or the sea water levels are increasing. Your entire impairment testing could change actually. Look at those assets in areas where there is change in the climate and there's a severe rainfall, landslides are there. The destruction of those assets, the risk is much higher. Now, why are we talking about all this? Is because of all this, risk is higher. Because of the risk is higher, your organizational goals cannot be met, and therefore you need to have a strategy for it. So climate change is one big risk that we are looking at, and globally this is being addressed to different ways and means. The second big risk that you are looking at is the cyber risk. I'll also try to give certain practical examples here. If you look at the recent news reports, there was one PSU where they had a ransomware attack, and SpiceJet also was one of them where they had a ransomware attack. Now, we are not talking about taking away information from one computer or from one system, but from an entire entity, or rather from an entire community itself. And now that hardly anybody goes to a bank, all our banks are in our mobile phones. We only think that we are as safe as we are now, but it's not so. So cyber risk is again an evolving area wherein the information is not secure, and all the more when people are working from home. How are you sure that they are not sharing information to somebody whom they are not supposed to? So there are certain cyber risks that are evolving, and we need to keep in mind about that. The other risk that I'm looking at is artificial intelligence and machine learning, cognitive techniques, because they are all replacing humans. Let us be very honest. There are many things that have where there was a manual requirement, but it has now been taken over by the machine. Is this going to be the order of the day? That is how it is going to be. Whether it is in industry or even in audit for that matter, AI and ML has already come. I think the days of selecting samples are over now. It's only numbered. So as long as the information is available in a soft copy, in a soft form, using these techniques, possibly tomorrow we may have to do the audit of 100% rather than doing a sample check. So there's an argument on that side also as to when a machine can do 100% checking, why not do it? Since you are doing it manually, obviously you couldn't check thousands of vouchers, so typically you would take a sample. So there's also an argument on that side of the story.
Yeah, I think, sorry to interrupt you. I think on that point that you just made, there's been, I remember reading an article that is artificial intelligence going to take over our jobs as auditors? Is that the next disruption for us as professionals? And I think to link it with what you're saying and with your topic, is it that the risk assessment, we need to do our own risk assessment and think ahead of the curve, invest in technology, invest in artificial intelligence, so that the point you just made, that you're not just going to do a sample checking, and when you've got artificial intelligence to do it all for you, take the whole population and point out the outliers. Why do you need to do sample checking? So I think do a risk assessment on ourselves is become more important than thinking of the client.
Absolutely right, sir. And more so as professionals, when we are looking at different client types, right? And they would have adopted this technology, you will be forced to develop and have the technology with you. Otherwise, we will be redundant. Simple. Now comes the other risk is on the data privacy. If you look at the data privacy laws that are coming up, something like GDPR that is coming up, it's already there in the Western. So India will have its own set of data privacy. How is our data being used? How is our data being secured? How is it going to be available? So that is something, another risk that is going on. Just to give one example on this AI, ML, robotics. If you just do a Google search, you find out that there's a company called Fanuc in Japan, where they call it something like a light out factory. So typically there are no human beings, I believe. It's everything is done by robotics. So you can imagine a situation where you don't have employees, but there are 10 robots which are doing continuously the work. Your entire the way you look at the business completely changes. Right. The other risk that you're also looking at is a financial market risk. Again, I'm not getting too much because we are all aware about the stock market, it's up and downs. More important is the last two risks is on the social media and the culture risk. Now, social media risk is you never know, somebody can write something in Twitter and put it on Facebook. Then you spend a lot of time trying to justify or to defend that this is not the case, or information can be leaked out to social media. There are cases where, especially in the case of listed companies, right, when it comes to prevention of insider trading, there are cases where across the world people have used social media to pass on certain price sensitive information. The social media has again become a risk. Once upon a time, social media was used to just say hello and hi to a friend. But now, social media is there to recruit people, to hire people for advertisement, for mass communication, to spread the news. Now, whether the news is credible or not, again, that's a risk. So social media is something, an emerging risk that all the entities should look at, and is the culture. Now, what is the culture risk? Now, when you acquire a company or acquire a business, or you have established businesses in different geographies, the people come with different background. The way they look at it, their mindset, their upbringing, their training, their background will also affect your business. And that is what we call it as culture risk. And culture management, again, has become one of the areas because it is for the tone at the top to ensure that there is a culture in an organization. But when you have to change somebody's behavior, it's not going to be easy. So you have to live with that in such a manner that you have to coexist. You have your own way of doing things, but there is an organization has a certain way of doing things. How do we ensure that both of them go together hand in hand wherein the objectives are right? So cultural risk is something which is very, very relevant now. Now, when you look at these risks, now the question is, how does it impact us? And some of which we have already discussed. One is we are now living in a stage where there is an increased dependence on automation, technology, right? Everybody knows about it. We had to learn Excel when we first saw computers, but these days they're taught in the school. Possibly next generation, they won't teach ABCD, they'll start typing on ASDF on the keyboard. Never know. Then we are living in a place where it is hyper connected. Nothing is called as my information is private. If you are good in doing a search, you will always find my information anywhere. So that is something which we are looking into. And the behavioral science, the way we look at risk, the way we train people, that is very, very important. Now, more than the technology and everything is our regulation. So there has always been a race between the innovation and regulation. Who comes first? You invent something, there's immediately a regulation. Just to give you two examples. If you look at the audit reports given by the statutory auditors, it has completely changed over a period of time. Next year, we are going to report on whether there is a log of IT, changes made in the ERP system. So you need to know what ERP is. You need to know what a log is. You need to know what an audit trail is. You also now have in Caro reporting on cryptocurrencies. So what I'm trying to say is the regulator is also catching up. It's like a Tom and Jerry race. Who wins first? You bring something new which is not there in the regulation. Immediately, regulator says, "Hey, I am here. This is a regulation that can come in." So there's always a race between innovation and regulation, and it's like you need to be ahead of the curve. And this is what I see is, again, my personal view here is regulators are also there saying that we have also employed professionals. We have also employed experts. They will bring these kind of regulations, right? And after all this, we cannot get away from the world saying that, sorry, this is too much, I cannot live. The beauty of it is we need to live with these uncertainties and disruptions and continue to be successful and relevant. And that's how many of the companies are there. If you see, look at history, there have been companies for the last 100 years. How are they able to do it? So they were relevant. They came over those disruptions. They managed the risk very, very well. And as the old age saying goes, prevention is better than cure. So always look for, don't look for medicine after you fall sick. Try to be safe, try to prevent the illness itself. So the old age still continues on, prevention is better than cure. When you do all this, keep an eye over what is that you are going to monitor, the KPIs in the risk management, how is that you're going to quantify it, and how is that you're going to measure it, and take a holistic review. So this is part of it, and the moral of the story is we come from different places, the resources are different, the time is there, efforts are there, business dynamics are there. You need to manage all of them. Now, going through that, how are we going to set up an enterprise risk management framework? What is that we are now trying to do? So this is the last but one session on how are we going to build a framework. We now know ERM is required. The first step I would rather say is start from the scratch, start from a new page. Whatever has been done in an organization in the past, done in the past. At best, you can have some leverage of the information or the data or the experience that you had gathered. But what is most important required is the change in the mindset and change in the culture. We are living in an era where every day everything changes. So change is part of life here, and therefore we need to understand that the mindset should change and the culture should also change. Once you have that in the mind that we are going to set up the ERM framework, the next important thing is to have the blessings of the top management. We need to bring them awareness. We need to have educational programs, give them what are the benefits, because unless it is approved or unless it is blessed from the top, it may not be successful down the line. So we need to engage with them, discuss with them, show them the benefits that they are going to get, and also talk to them as what is their expectation. Possibly look at their viewpoint, look at the results or expectations that they are looking at, and try to see how we can find a mid path towards successful implementation of ERM. The third aspect here is we need to start from the vision of the organization. That is extremely important, and it goes back to my earlier and the preliminary slides that unless the goal is determined, it doesn't matter what action you do. So it can go anywhere. So first we need to fix a goal to an organization and then say, these are the actionable steps. These are the actionable strategies that we need to take to achieve that goal, and have a timeline by when we would like to achieve. By 2030, I would like to achieve this. By 2035, this needs to be achieved. And it has to be realistic. Now, once it is done, the actionable points needs to be taken care of by breaking it down as to who is going to do what, who is going to be authorization, what will be the delegation, what will be the steps that will be done, will it have finance or non-finance. So all the strategies needs to be built up in the third stage to see, okay, this is where we are going to. This is the point where you are going to decide as to what would be our destination and where we are going to reach. Once we know where we are going to reach, is the fourth step as to benchmark what others have done. This is again when you are in a similar industry, when you have colleagues, when you try to find out as to what is that they have done to achieve, what is that they have done in terms of setting up their goals. Are you comparable? Are you going to be benchmarked with the peers? I am not saying that we should be doing it, but it's a good reference point, I would say, to help to understand, are we in the right track? Is that what we want to achieve? So what to approach, what are the aspects to be covered is all governed here in the fourth step. Leverage the data. Now, when we say leverage the data, You might have certain information already available, or you may have to get some more data using data analytics, using technology, etc., and then see, is this data going to evidence or going to tell me that this is what is going to be achievable in terms of the vision of the enterprise. Now, once we know that this is what is going to be achieved and these are the actionable plan, when we have certain information available as to how to go about it, fifth stage is very, very important, what we call it as identifying the risk universe. Now, this is the place where we need to understand what are all the risks that we are going to identify and prepare something called as a risk register, which needs to be constantly updated. Now, when we typically prepare the risk universe, you will consider all type of risks, including the emerging risk, and then see how it is going to impact the organization, break it down to how it is going to impact a process or a geography or a process, or a transaction, and try to interlink it, because the entire idea of having an enterprise risk management is to have a global to have a macro picture, to have a big picture, what is that is going to finally happen. So we need to break it down till the granular level. Now, once we know that these are the risks that is going to happen, the sixth step typically would be to have a document or to prepare a risk control matrix, I would say, wherein you will say against this risk, you will have this particular control. Now, when we write this particular matrix, why do we have to document? Why am I stressing it has to be written? Is the way I express certain things, you could interpret, you could understand in a different manner. Therefore, documentation is extremely important. There are three different things. One is control objective, one is control activity, and this control description. And these three things are very important. Why? Against a particular risk, you will first define what is that you are trying to control. For example, you have purchases. You are trying to have a control which says that the purchases shall be through the approval of so and so person, because you don't want unauthorized purchases. So that's the objective. Now, when you have an objective, you also need to have an activity. So you will then define that so and so person is responsible for approving purchases up to a certain limit. So that's the controlling activity. Then you need to describe it. I am having this objective and activity so as to mitigate this particular risk. Now, when you define all this, have a common language, have a common verbiage, because you don't want another set of interpretations coming over. That's the reason in any company, the review of risk control matrices over a period of time is very, very important. And then once you have that in place, you know what are the things to be done. Then it is more about the people who are executing the work, making them responsible, making them accountable. Training is an essential part in ERM. Every process, every person will be doing something, and therefore they have to be trained in ERM. They have to be trained in risk management strategies. Now, when it comes to human resources, when it comes to training, you always know that unless you reward for a good work, there is no motivation for somebody to keep doing it. If I have to be in practice, if I have to be in an industry, I should have some motivation. There must be some reward for me to being here. Therefore, there has to be a reward for compliance. There has to be a reward for risk mitigation. At the same time, you also need to ensure that there is some amount of penalty, some amount of disadvantage if they don't comply with it. So why I'm saying this, as a process, it should be there in their DNA that if I don't comply with this, there is some action. And when we are talking about ERM, you should always have a cross-functional team. Why am I talking about cross-functional team? Because here you are not looking at one process as a whole. You are looking at the risk and how it is going to impact all other processes or all other areas which are very, very risky. Many companies also have this risk management committee whose job is typically ensuring that these activities of risk management are carried out and they report to the board or they report to the top management. So establishing a risk management committee may not be with the same name, but with a team which is responsible to ensure that the risks are covered and the risks are managed. It's very important. Sometimes it is taken care by the internal controls team or by overseen by the internal audit team. Yes, Aditya, you were saying something.
No. Please carry on. I wasn't.
Right. So once we know that there is a structure in an organization which oversees the risk management process, then comes the accountability. Yes, if I don't follow, there is somebody to catch hold of me. So that overseeing, that supervisory role has to be played by the risk management committee. Now, once we have this, it is now time to make it as a culture in an organization that anything that I do, first thing I have to think is it risky? Is it going to harm the company? What is that I should do to ensure that it doesn't harm? So it comes as a thought process. It comes in the blood. It comes as a DNA, I would say, and ensuring that the risks are mitigated at all stages and not only at the final stage. Every step, every stage, this is to be covered. Last but not the final one is the continuous improvement. Look at the concept, something like Kaizen, where you continuously improve the quality. So there is a requirement that somebody has to continuously monitor and see how we can do better, how we can improvise our processes. The last one, two steps are independent review. So who should do this independent review? I would suggest better an external professional, or if you have an internal audit team within an organization, they should review this entire enterprise risk management framework and see whether it is compliant with certain frameworks. Now, when you prepare financial statements, you say this is in compliance with accounting standards, Ind AS, IFRS. When IFC reporting comes up, they say this is in line with the guidance note issued and all that. Similarly, for ERM also, when somebody has a review, they need to review and benchmark it with some authoritative literature like COSO and say this is in line with this particular framework, which emboldens, which reinforces the fact that we are benchmarked our practices with something globally accepted practices. The final step is to again go back to the management and then say that this is how we have implemented ERM, this is how the results are, and if there is any corrective action to be taken, it needs to be taken. The steps 1 to 10 that I've just described this, I've just simplified it, but if you actually try to do it practically, you will definitely have certain challenges in terms of resources, in terms of time, in terms of documentation, information, and most importantly, in our experience, it has been resistance to change by people. So that is the most important thing. Unless the people make up their mind that this is how I am going to be, nothing can be done. But some people make up their mind that we will change, we will accept the challenge, we will move on to become a better organization. Only then things will start moving. So Aditya, I have an old saying here which says that for a person who knows where he has to go, the whole world will step aside.
Absolutely.
So the first thing is they should know where they are going.
Very rightly said, Aditya. And I just wanted to ask you a question on the step 9.
Sure.
Are there any, like you mentioned, like we have a regulator, for IFC, we have a regulator for, we have standards on our auditing. Is there some resource material that our professionals can go to access what should be that framework within which they should look at this? And is it something that we as chartered accountants can do?
Yes, sir. I would answer the question in 2 parts. One, the institute itself has material on SIA 13 for the internal auditors, those who are practicing internal audit, they can look at that material. Second is the regulators. I will give the reference to the circulars given by various authorities also. They themselves have given that this is how the risk management has to be. And this is how, what is their expectation in their mind. That is the second literature, which is relevant to our geography and our industry. The third I would always look upon is what are our friends doing across the world? Because ultimately we are living in a globalized economy. Our practices have to be the best in the world. So I would rather look into what is the similar company, say in England doing, or similar company in Australia doing. How are they managing it? Is there something that we can learn from them and then take it forward?
Got it. So nice. And I think what you just said in the end is relevant, not just for this. I think it's relevant across the board because, we almost speak the same language in terms of accounting, tax, technology. I mean, so we can always, because it's always considered they're 2 steps ahead of us. So why not at least be by them, if not ahead of them, at least be by what they are doing and be at least at par with them, if not ahead.
In fact, we are actually doing that, sir. If you look at the recent past, especially because I come from the audit background and India is my favorite area. If you look at it, there are standards which India adopted much ahead of what the world adopted. For example, India's 109 for the
Yes.
revenue recognition. We were the first one to adopt. We didn't even have a precedence as to what were the rest of the world doing. The good thing now about us is we are now become very aggressive in terms of adopting to certain new technologies. Even for as simple as making cash payments. I don't remember the last time I went to an ATM to draw cash. Because you now have electronic wallets, even a small street side vendor, he has put up a QR code through which you can make a payment. So we are adopting to the change rapidly, especially in the last 2-3 years in the COVID scenario, right? When hardly people knew about video conferencing and remote audit, remote working, we were able to adapt to it, and there was a push for digitization. Now we have come to a situation now, even if you ask people to come to office, they'll say we will work from home. Right? So the way we are looking things has completely changed. So that is where our next topic would be on Erm taxonomy, or how does this affect? If you look at each one of the category definitions, what it affects, it is actually interrelated to each one of them. For example, if you take financial risk, it again boils down to what your business does, how good is your reputation, what has been done in your operations for you to lead this, what is your strategy there. So each one of these risk categories, if you see in one or the other way, you can always link it to the next one or the next one and say that one risk is going to bring so much of or will impact so much in the business. So how are we looking at it? For example, if I say financial risk, the one way to look at it, for example, is like drilling down to the trial balance from the balance sheet. So you have a balance number in balance sheet, then you go to the schedule, then you go to the group, then you go to the subgroup, and then to the ledger. So similarly, if you look at the way ERM is getting constructed, suppose if you're looking at operational risk, so there they're breaking it into whether it is human, capital, process, digital, or external risk. Within the process, there are a lot of processes that you have in operations. Data quality, adoption, end user adoption, financial reporting, just giving an example. And within legal, they're saying contract enforcement, litigation, arbitration, settlement. So it goes on to level 4 or level 5 also sometimes as to how granular your risk management has to be, rather than simply saying at level 1 that we are operating and this is the risk management. Now, how is this going to benefit? Why are we looking at all this? Is the way we focus on certain risks, the way we look at certain transactions, the way we report is all inbuilt in this taxonomy. Again, I would not go much into this. Now comes the important topic for us. What is there for us? End of the day. This is a small clip that I took from the International Federation of Accountants, which says that many professionals, and this survey was done in 2017. I'm not sure whether there was any other survey done after this. I tried my best to get it. If you look at that, the IFAC says that not many professionals know about risk management those days. They are saying that we need to go beyond the traditional areas of statutory audit, tax advisory, internal audit. They are there, but you need to top up with that something. And considering that as chartered accountants, we have the leverage of knowing the business very well, knowing the risk of the business very well. It will help us to serve the client in terms of telling them as to how to move towards a ERM environment. And these days, I won't call it as opportunity. I would rather call it as responsibility itself, because each one of us are responsible either as statutory auditors or internal auditors on one side, or as people working in the industry. Both of us are responsible for the success of an organization. That the gap between industry and practice is not there. You are looking at certain amount of risk. I am looking at certain amount of risk. All that we are doing is trying to see there are two pairs of eyes which are looking at the risk mitigation strategy. So this is something very, very important. And what is the skill set that we need as a professional to do this is something which I think we have in terms of our training, in terms of our experience. Because right from our articleship days, we have been always taught first is understand the business. What do they do? Based on your understanding of the business, then comes the accounting, debit, credit, the numbers will flow. But unless you understand the business, nothing can be done. Then what tools, what models, what is the risk framework? I think as auditors or as professionals, we can do this. We have already done it in the past. Enhancing quantitative and statistical skills. Analytical procedures is something which we are very, very know about it. We know statistics. We know we are able to connect the numbers. That's the beauty of our profession. If something goes up, we know what should go down or what should not go down. So that beauty of relating the numbers and correlation is something which is inbuilt in us. And then comes the softer skills of ability to lead the team and ability to train them. And last part of it is very important, is the confidence to ask difficult questions. I would rather say we are known to ask that. As auditors, we are known to ask, we are supposed to ask questions.
We are supposed to, but I think sometimes, I think this is a very important element that is required of us, the confidence to challenge and ask difficult questions. Sometimes as auditors also, we don't go in that mode. We restrict ourselves to just numbers. And I think those difficult questions can be about business, can be about their processes, which all that you're talking about in here. I think we're doing it as a auditor, but I think why not pick that out and also give that as an additional value add to the client, so then it becomes it's something that the client values in your audit process as well.
Absolutely right, sir. So that confidence comes through what? It comes through the pedigree, it comes through the training, it comes through the mentorship. And I would also rather say that it also comes with the confidence that you have a regulatory body which can stand with you, which supports your view. If I take a stand and say, this is what my institute says, or this is what the regulator says, it's not going to be a difficult question. I can only say that I have a question, you have to answer, because it's not for me, it's for the stakeholders. If not me, there is somebody else who will ask. So the choice is, whom do you want to answer? So one of our questions that we had was, what is the opportunity for chartered accountants? Now, if you look at the survey done by some of the firms, they say the global risk management consulting survey is going to be a staggering amount of close to 146 billion by 2027.
Wow.
Right. So there's a huge market available where people are looking at risk management. People are looking at integrate the risk, understand financial and non-financial matters, especially those companies which are having diversified business, have set up across geographies. They need at one point to see that how is my business performing? What is my risk management strategy? Risk management strategy, advising the company itself has become a big profession now. there are such specific certification courses also, rather, I would say. In fact, I did see that there is a certification in ERM from the institute, but I guess it's under restructure. That's what I read on the website, that the Committee of Internal Auditors, etc., are taking care of them. You also have a certification here on DIRM, from an insurance risk management. I'm just saying that there are now courses available which specializes only in risk management, which we thought was a chapter in one of the one of the contents in CA final. So now what is happening? You are going to laser focus only on this, and then advise the client on so many other aspects of enterprise risk management. So that answers what is the opportunities available. Coupled with the skills that you need is on the data analytics, on the technology front. I may not be good in all the technologies, but at least I should know that this is what works and this is not works. So now you cannot tell that I don't know this. At least you should know something of AI, ML, which will help you to understand data, visualize the data, present the data, etc. And keep an eyes and ears open for so many risks that are happening on social media, technology. In fact, we didn't even think about geopolitical risks.
I was going to put it, I was going to put it to you on your diagram that you were talking about emerging risks. That, you know, while you did cover all of those, two emerging risks that we've faced in the last 2 years. One is the pandemic, and the other is the geopolitical that we're facing right now. I mean, nobody could have thought of that this would come and disrupt all our lives the way it has disrupted.
Aditya, to be honest, there are some financial statements which have already come out in the public domain. The war between Ukraine and Russia, which we call it a geopolitical risk, there is certain financial implications for certain companies here, and that has come into the notes to accounts, and they have taken a call on whatever needs to be done. So 10 years back, I wouldn't have thought about geopolitical risk affecting my business here. Coming specifically, if you look at the banks, for example, I have also given reference to the Reserve Bank of India's circular in this slide, which is an hyperlink. So if you go to this particular hyperlink and click, you will find the circular given by Reserve Bank of India, which they started on ERM way back in 2012, and they have been constantly updating on that. Now, they have introduced a lot of things, including mandatory IT audits, cyber risk to be considered, introduction of Chief Information Security Officer, portfolio-based credit value at risk, and expected shortfall model. And now that all the banks are in CBS mode, there's a lot of emphasis on mobile computing and technology. Unless we understand how the system works, how the algorithm works. For example, a very simple example is how does an NPA classification is designed in the system. Unless I understand the system, unless I understand its process, I will not be able to actually do an audit, right? Or how does a bank particularly charge a particular customer for a particular service? It's all automated now. So auditors now also have to ensure that they know about technology. More than that, they should know about risk management. They should know about data analytics. They should know about how an IT audit is concerned. Only then we will be able to do the audit for somebody like financial institution or banks. Even for NBFCs, there are certain requirements on enterprise risk management. There are certain guidelines as to what they should be doing in terms of data protection, etc. So there is a big emphasis even by regulators like Reserve Bank of India. Even IRDA, enterprise risk management, is there for insurance companies. Insurance company by itself is a risk management. Everything we talk in insurance is risk. So right from integrating their finance, actuarial valuation, the strategies, underwriting, investment management, and strategies, everything is based on the risk. Now, if you look at the pandemic, most of the insurance companies had to make a loss. Why? Their claims ratio went up, and at the same time, their value of investments also came down. So it was a double whammy to them. Again, this is a lesson learned. So they have to now look at various ways to mitigate those kind of risks. Then you have something called as reinsurance also. So that's again a risk management strategy. So again, for insurance companies, there are good amount of opportunities available on advising on at different levels. Mutual funds, again, risk management framework has come up, wherein there is an annual review. Then you have to look into the operational reputation, financial risk. Here also they have come up with the role of risk officers and CIO. So even mutual funds, when they have to come up now, a lot of regulations that has come up, and there are, penalties are actually very high if they actually don't comply with those kind of regulations. Listed companies, again, SEBI's LODR requirements requires formation of risk management committee, their roles and responsibilities, the minimum quorum they should have, and most importantly, the disclosure they have to come up in the annual report on how they have mitigated the risk. Interestingly, here, if you see, it is not only sufficient to give certain disclosures in the annual report on risk management. If you look at the financial statements, your Ind AS 107 requires a lot of disclosures again on how do you manage your foreign currency risk, market risk, capital management. That has to marry with this. So again, in the annual report itself, you have two sets of information which should go in tandem. So even accounting standards have now included the risk management aspects. Just to sum up, there are certain trends that are appearing, which we have already discussed. One is on the cyber security, business interruptions, talent management. This is again a big time change. Now we are looking at people leaving the job at the top of a hat. There were days where people were finding a job and then leaving. Now it's the other way around, because the jobs are in plenty. Then third party risk, that means you have outsourced your activity to somebody else. You believe that they will be doing like payroll processing, but that person has already transferred the work to somebody else. So that goes like a subcontract. What kind of risk that you are looking at? So some of this which we have already covered. What we are also looking at is for the final discussions and thought is how far we are understanding ERM is important to do both as a statutory auditor, as an internal auditor, or from the industry perspective, because it has its implications in the financial statements, it has its implications in the financial reporting, corporate governance reporting, ESG reporting, and compliance with regulatory compliances. So my submission here is ERM, don't look at that for compliance requirements. That is anyway to be done. But for your own good, for your own business, to visualize that what can go wrong, take steps to ensure you are safe and conduct business in such a manner that we are going to achieve the goals that we had established in the, while setting up the whole ERM system. So if you have any questions, I'll be happy to take, and anything in the chat box, I'll be
Yes,
happy.
I think there's one question wherein they're asking that in an organization, can risk and compliance stay together, or is that a conflict?
In an organization, can risk and compliance stay together? Yes, it has to, because what is compliance? Your regulator is asking certain things to do. You need to do this, this, this. Yes, that's a duty. You're responsible. You have to do it. Now, why does the regulator ask you to do it? Because you have certain transactions. Risk is there in transaction. You have to mitigate that risk. So according to me, these two are independent of each other. Risk is there. You have to mitigate it. And then you have to comply by reporting certain requirements. According to me, there is no conflict. These two are completely different. What do you say, Aditya?
I think maybe the question, if I understand what the gentleman is trying to ask, is that can, as a professional, I provide compliance services and enterprise risk management services to a client at the same time, or is that a conflict? I think, if I'm not wrong, that might be the question that the gentleman is asking.
If I am a statutory auditor, possibly I have certain restrictions in rendering certain amount of management advisory, because I am a statutory auditor. I have independence issues. I have conflict of interest. But if I'm as a consultant, but if I'm as an internal auditor, according to me, there is no such conflict. I am only what we call complementing my work or
Exactly.
doing some additional service. So it depends on which role I am playing. But if I'm a statutory auditor, I won't take unless I have an opinion given by the government or by ICA that this is not a conflict of interest, then it is fine. But if the law says it's a conflict of interest, I stay away from that.
Of course, of course. Right.
So very other important also aspect here is when we do the audit or when we look at the businesses now, the most important challenge here is how often do we actually monitor this risk? This should be done on a quarterly basis, should be done on an annual basis. According to me, this is an ongoing process. When it comes to the reporting requirement, only then you have a board meeting, you have the risk management committee, which looks into these kind of risk. But then this has to be a concurrent activity.
Right.
And one more question I was actually expecting is what would be the cost? Is it like my cost of compliance is already increasing? My time and efforts are already increasing. Should I really invest in all this? Do I see benefits in it?
Correct. You took away this question from me. I mean, that's precisely what I had in mind, that how do we, with the scope, even if, let's say, as a statutory auditor, I'm required to be doing all of this and providing this as a value add, or even as a basic part of my service that I'm doing as a statutory auditor or internal auditor. What we've gone through in the last 2 hours, what you've thrown light on in various ways that we can complement those services. How do I price myself? I mean, what's the cost that comes associated with doing all of this simultaneously? So that's definitely a question that I had. And there's one more that I had. In the beginning of your presentation, you were talking about to assess risk. And you said that there's some technologies. What kind of technologies exist? Would you be able to share some sort of examples or some tools that our members can use to assess the risk that are available online?
Yes, sir. I had saved certain files which I can share it with on email, which you can actually distribute to the members. What I'm also looking at is now the data analytics. Now there are two things. One is that there is a data. We analyze the data, and then we try to find out what is the risk. What I'm also trying to say is our data analytics itself has become so sophisticated now. It gives better insights and in-depth information. So my risk assessment has now improvised. I'm going beyond Excel's filters. Right. There's also a question, can ERM and compliance function have common reporting? As far as the compliance is concerned, you have a specific reporting requirement, it's a specific report on which you have to give it. Now, when I'm talking about ERM reporting, typically companies build dashboards which say that these are the risks that they have identified, what are the new risks that they have identified, how are they mitigating it. It is part of the dashboard or an MIS which actually goes to the top management. There's a question on how to mitigate risk on outsourcing. I think this is a very important question where most of the companies look for outsourcing. We already have standards on auditing on this one, 402 for the statutory auditors to look at it. So when there is an activity that is outsourced, for example, your company has a payroll activity that is outsourced. Correct me, Aditya, if I'm going wrong. As a statutory auditor, I need to understand, first of all, what is the contract with that company? What does that company do? Or the service vendor? What are the controls prevailing in that organization is something which I am keen to know, and about the confidentiality and audit rights that you have. Now, it is quite possible that the service vendor is going to provide payroll services for 100 other clients. Obviously, everybody cannot go and do the audit. It is impractical. So what now the companies have actually done is they will definitely employ an independent professional and get their internal controls audited. And that's where your SA 402 talks about type A report and type B report, where you required to look into type B report specifically on internal controls and whether they are operating effectively, and then use that report to understand what are the internal controls. This is one way that you can get satisfied that the controls in the service vendors organization has been good, or there are certain risks that have been mitigated. That is one way you can look at it. What are the factors that need to be considered for strategic risk profile for an organization before ERM? I am not very clear on this question. Aditya, any guess what is expected?
What are the factors that need to be considered for strategic risk profile for an organization for ERM? I'm afraid I'm not able to understand the question. So
if you read the first half of the question, factors that need to be considered for
strategic risk profile.
Yeah. So what will be the strategic risk? Strategies could be, how do I get a market share? And this, should I get into this particular geography or not? What is my customer base? If I'm talking about strategies, should I outsource it or should I not outsource it? Should I manufacture it or should I not manufacture it? There could be certain operational level decision making. There could be certain organizational level strategies that the companies will have. Now, when they look at these strategies, the question is, if things go wrong, what is the strategy they have? What can go wrong is, first of all, suppose if I have to manufacture something, I know that I have a team which will look into quality. I know I have a team which will do the procurement, etc. I don't want to do all that. I want to outsource it for somebody. He will do the procurement, do the processing, and give it to me. What is the risk I perceive? The risk I perceive there is whether this person is going to deliver it to me at the right time, at the right quality, at the right quantity. Do they have sufficient infrastructure facility to support my operations? So I am looking at wherever there's certain decision making, I am going beyond that and trying to see why is that decision being made? Why not an alternative course of action which could have been available? So if that is the condition, then I will try to go and find out, if I outsource this activity to a particular vendor, then I will try to find out what should I do to ensure that I get the goods at the right time. What should I do to ensure that these goods are of the right quality? So what I would do, rather I would put one quality control person to see that it matches, or audit their processes, or visit their premises, talk to some of them whom we know in the business circle, and then see whether we can empanel this vendor or not. So I'm just giving one example. Similarly, if I have to test waters, if I have to go to a particular geography or not, I would rather look at my other friends in the industry. Did they go there? What happened to that? And I may not go in a full-fledged. I may go and do a sample and then see, okay, this is successful. Then slowly ramp it up to the next level. Once it becomes successful, then I do it. So when it comes to strategies, again, I broadly, what I would do is, I would look at what could have been the alternative course of action, what options do I have, based on which I will take certain decisions. When I take decisions, what is that I have done? Did I do a due diligence of that particular activity? Did I look into some other aspect and consider that what if I don't do?
Wonderful, Aditya. I think we're out of questions, and we're now getting people commenting that it was a wonderful session, that they were able to, I think, take back some value and learn a lot in the last 2 hours, or about enterprise. How do you risk management, and I think we've covered a lot of ground in the last 2 hours, and I think the takeaway that I probably see is that, of course, as a practice area, this is a tremendous. You mentioned in the report that I don't know how many $1 billion industry, 100 billion plus over the next 7 years or 5 years. I think that in itself is testament that this is definitely a practice area that our fellow colleagues can pick up and start harnessing their skills, start investing in the relevant tools, relevant education, relevant technology, so that they are up to speed and are able to deliver that sort of advisory service or a compliance service or a risk management service to their clients. I think that's my takeaway, and and I'm sure people would have many more such takeaways. Yes, please.
I just have one more to add. Is now we are in such a place or a place in the economy where you have large organizations been there for decades and years, right? Having some value, right? You have a brand new organization with very little experience, which we call it as unicorns, right? They are also competing and getting the same value, right?
Right.
But then, in my experience, what is also required is many of these younger companies, I would say, or younger businesses require more support, more advisory in terms of, because they're growing in large scale, they're very aggressive, the funding is there. What is required is also to see that they have an eye on the risk.
Right.
After putting all the efforts to get the capital, to get the resources, make their idea fruitful, bringing a good product, the last thing is required is a failure. So nobody wants that.
Right.
So as risk management professionals, I think there is a good amount of opportunity, especially with the startups, right from as simple as, do you have a standard operating procedure, for example. Many of them may not even have it, because
Correct.
they are concentrating on business, they're concentrating on funding, they're concentrating on business deals. That is where is the vacuum, and that is the place where we have to fill in and say, you take care of all this, we take care of this, to ensure that when you do the business, you don't have to be really worried about what is going to happen if this fails, because we are there to tell you that do this, do that. We are there to tell you that this is how you should manage the risk.
Absolutely well said, Aditya. The startup domain and area is again a great scope of work, like you mentioned that, and you're right. I mean, even from my experience, they generally don't have the SOPs or a business continuity plan or a risk management plan in place. So, and which I think is required more for them than probably an established organization, because they are on the brink. They're working on an idea, on a concept which could potentially fail, and we've seen a lot of such businesses go down like a dominoes. So I 100% endorse and agree with what you just said. So yeah, I think with that, I would like to take this opportunity to thank you, Aditya, for your precious time and for this wonderful deliberation, wonderful session that we had, which I think members would definitely have a positive take home, a value.
I'm happy to get their feedback.
Yes, definitely. I think the team members and the secretariat will be able to get when we hear back from them. So with that, I would like to thank you and to the members for taking out time in large numbers to come and attend this. I think that's in itself is testament that this is an important topic, and what this committee stands for, that this is a new practice area that you can develop and start working today. Thank you. With that, I'll end the session with that. Thank you.
Thank you.